Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
But very important that everybody understands that technical analysis is not certainty. It's probabilities. Every moment in the market is unique. There's different market participants this time in your bull flag or your bear flag. There's different circumstances that are causing traders to react the way they are. And so you cannot get it in your mind that every single solitary pattern or indicator is going to be successful. It's just impossible. At any given time, somebody can jump into the market with a different opinion than you and have enough firepower to move that market. So you have to, as a trader, recognize that you're dealing in just probabilities, something giving you what we call an edge when you trade. And so it's also important to understand when markets are not trading in trending periods, when they're going sideways and they're going flat for long periods of time. The 1966 to 82 period in the Dow Jones, for example, was a very, very long time where prices basically went up, down, and nowhere from 66 to 82. And from 1993 to 2003 in the British pound versus the dollar was another period of just sideways movement. And we'll actually look at some of those charts to see what that looks like. But there's other times where the market really does move in what we call trend moves, up in bull markets and, of course, down in bear markets. And these trends can last for equally long periods of time. As a matter of fact, something that I've been introducing recently when I teach my classes is looking at something called generational time frames, or what we call secular trends, that can last for many, many years. And, of course, during those secular trends, we're going to have trends that are related to economic cycles, which we call cyclical trends. And when I do this presentation live in front of people, I always caution that every once in a while it's like a tongue twister and I mispronounce the word. So it's just trying to say it too many times. It's kind of funny. But the first chart we're going to look at here is a chart of the British pound versus the dollar from the early 70s until today. And very, very top of the chart back in the 70s, we have what we call a peak and very, very long sustained downtrend from that peak of around 260 to where on the most recent rally we had in 2008, the best we could do was 210. So we call that a secular downtrend, and it's been lasting for a very, very long time. We had a trough, which is the bottom for this particular cycle that you're looking at back in the 80s, about 85. And pretty much after that, we went sideways from the mid-80s till about approximately 2005. And we had some periods where we went up and tried to extend the top of the range above 2. And on 3 occasions, we failed when we tried to extend the top of that range. And then we kind of had a smaller, long trading range for a period of time for almost 10 years to where we traded between 140 and about 175 or so. And I want you to notice, though, on each and every sell-off, including the sell-off we had back in the bear market here for currencies in 2008, 2009, we sort of found support each and every time for this currency pair just around $1.40. And so that's why it's very important that you understand that prices can and do turn quite a few times in places where they've turned in the past. And I'd like to point out, too, if I can, that we'd also have one little period here where we had what we call a cyclical bull market during this long secular bear market in 2000 or so. It began a long, long period where the British pound actually started to break out, and we had a accumulation phase right here. And then we had a long, steady uptrend phase. And then we topped out in 2007, 2008 up here. And then we had a resumption of the downtrend or a declining phase. So this is what we call a cyclical bull market during a secular bear market. And this was a very, very big move. If you look at it from 140 to 210, that's a huge move in the currency markets. And many, many times traders would like to participate in these kind of movements. And so what you have to do is be able to use this information about the 4 stages that we'll talk about here: accumulation, markup, distribution, and markdown, because these cyclical bull markets are related to economic or business cycles. So secular trends can cover long periods of time, sometimes between 5 and 25 years, and that's no written rule in stone that says it has to be that length of time. And during that secular trend, we can have a series of what we call cyclical trends. Most recently, I can think of the gold market had a secular bear market from 1980 to 1999, and we're currently having a cyclical bull market, and we are rallying and making new highs. Not recently, but we did. So there's long periods of time in other indexes like the Dow to where we are actually having our 4th secular bear market since 1899, which was the inception of the index. We had a secular bull market from 1982 to 2000, and sometimes these secular bear markets last almost as long, so many people are projecting that the current secular bear market that we're having could last all the way to 2020. And I just want to point out that in the 1930 depression bear market, there was a 30% rally that occurred after a 45% loss from the peak, but the Dow Jones went on to lose 80% of its value before it finally made its final market bottom. And I know there's a lot of technicians out there that are familiar with long-term forecasting, such as the Elliott wave or another wave called the Kondracki wave. That's even a longer cycle, 54-year cycle. That type of technical analysis focuses on these secular trends of the market, these long-term trends that last for many, many generations. But the cyclical trends that we're having now, for example, in the stock market, the U.S. stock market, which is around 70% off its lows in this supposed secular bear market, these cyclical trends typically follow the 4-stage cycle, which is related to the economic cycle of expansion, followed by a peak, followed by a contraction, followed by a trough. And the phases that we look for are accumulation, which is a sideways trading, which generally happens after a decline. And large institutions build up large positions in anticipation of a move higher. They want to do so over long periods of time so as not to drive prices up. They like to buy low and sell high, so this is how they do it. Eventually, though, the market will break out into what we call a stage 2 uptrend or a markup. This is a public participation phase if you can catch it early. Okay. We also call this stage 2 the greed stage. Another name for it, of course, is just a bull market. Then we have a distribution phase, usually where sideways trading happens, and the institutions which bought low usually transfer their positions to more novice investors. And this happens after a prolonged uptrend. And of course, everybody's all excited about the market by that time, and you can just think of a few markets that recently have been moving higher and higher and getting people more and more excited. And so if you understand, there's a possibility that this could turn around and break out to the downside too. You may not get caught up in that stage 4 decline cycle. And what happens in this cycle is that everybody that bought the top either starts to get out early, or eventually they start to get out and they start to panic. And so we call that stage 4 cycle the fear cycle.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.